Hello everyone, welcome back to the Bruce Banks Show. I'm Bruce Banks and I talk about money, finance, and the world around these topics. Today I'm going to be giving my response to one of my favorite YouTubers, Stephan, in his video on why it's a bad idea to pay down your mortgage early. I have a lot to say about this, and hopefully I can clear up a lot of misconceptions and give different perspective. So don't forget to turn the like button blue, and let's begin the video.
What's up, you guys? It's Graham here. So contrary to popular belief, paying down your mortgage early could end up costing you tens of thousands or hundreds of thousands of dollars in lost profit. And to prove this, I will be sharing with you guys some real-world examples to show you the math behind this. If you take the time to utilize this topic and fully understand it, it could very well make you 6 figures richer when it comes for you to decide whether or not you should pay off your mortgage early. Now, most people just conventionally look at the cost of the mortgage over the term of the loan, then they see that final number and feel like they're just getting ripped off. Then they just feel like they want to pay it down as soon as they can. So let's look at a very common example, which is a $400,000 loan paid over 30 years at a 4.2% interest rate. Now, over 30 years on paper, it looks like you're spending $704,000 over the course of the loan. This means you're spending $304,000.
That's nearly double the cost of the original mortgage. So that's a lot of money. So just keep that in mind.
In interest on a $400,000 loan. Now, most people see this and they think, that's a scam! Rip off, dislike, unsub. And then from that, they conclude that it's probably better just to pay off the mortgage as soon as possible so they don't have to pay such high interest. For instance, people might see the $704,000 total figure and get overwhelmed by that, and then just conclude, well, if I up my payments by $1,050 per month, instead of paying $1,965, I pay $3,000 per month, it looks like I will only pay $139,000 of interest over the course of the loan if I paid off early. This seems like the better deal instead of spending $304,000 just for paying an extra $1,000 a month. In theory, they should be saving $165,000 by paying it off early. But it's not the full picture. The reason why many people think this way is because they haven't really
Hit the subscribe button yet.
Looked at the full cost of ownership, what they're really paying, what their money is really worth, and instead they get hung up on seeing that final number, which is extremely misleading, and here's why. So in our $400,000 example, your monthly payment is going to be $1,956, meaning that over the course of 30 years, you're going to pay $304,000 of interest. Those numbers are going to be our foundation from which we're going to base all of our examples off of. And when determining whether or not it's worthwhile to pay off your mortgage early, there are 3 factors to consider. The first factor is the mortgage interest tax write-off, and this is what makes real estate investing extremely attractive, and also why it helps to keep a mortgage long-term. On a primary residence, you can deduct up to the first $750,000 of your mortgage against your own personal income. Now, when you have an investment property, you can deduct 100% of whatever interest you pay against the rental income of that property. So on a $400,000 loan example, in the first year, you've spent $16,640 in interest. This means that for the average person in a 23% tax bracket, you can deduct $16,640 against your taxable income. This means that you can save $3,827 in taxes. This means that when you have a 4.2% interest rate and you're in a 23% tax bracket, you can lower the interest you pay by the 23%, effectively making that interest rate more like 3.23% after your tax write-offs. Because remember, you're taking the 4.2% interest rate, lowering that by 23%, and that gives you the 3.23% interest. This is your effective interest rate you're actually paying after your tax write-offs.
Graham looks like he's doing some funny math here, but what he is really saying is that because you own the house, you now have access to a special write-off that you would not have had if you would just rented. The money the write-off saves can be looked at in a way in which it cancels about 1% of the interest rate of the mortgage loan. Obviously, it would differ person to person because everyone's taxable income is different, but 1% is a safe bet. So I kind of agree with Graham here. Real estate has many more tax benefits than this, but I see it all as icing on the cake, and it's like the government is paying you to own.
loans. The second factor to consider is inflation. Now, even though you look at the figure and you see $304,000 paid over 30 years, you have to remember $304,000 15 or 30 years from now is worth a lot less than $304,000 paid today. Because the bank is holding the entire loan over the course of 30 years and all you need to do is pay bits and pieces over time, it's pretty safe to assume that overall, on average, we're probably going to see about a 2% annual inflation rate. This means that even though you're only paying an effective rate of 3.23% interest after your tax write-offs, when you also factor in inflation of 2% on average per year, you're really paying more like 1.23% of interest.
Let me try to explain inflation a little better. Inflation allows borrowers to pay lenders back with money worth less than when it was originally borrowed. This benefits borrowers. So by the banks allowing you to use their money to buy a mortgage with their cash right now, you get to pay them back with weaker and weaker dollars every month and every year the loan is active. That is even more crucial of a fact in 2021. Generally, the Federal Reserve tries to control inflation so it does not get higher or lower than 2%, but they are now allowing inflation to go as high as 5% temporarily. At the same time, you can get a mortgage for 2.5% or even possibly less. So it's almost like the bank is paying you to own a house. That is why $1 today is always worth more than $1 tomorrow.
And the third factor now to consider is the opportunity cost of the extra money that you're putting towards your mortgage. The real question here is, can you make more than a 1.23% return adjusted for inflation, investing your money anywhere else than paying down your loan early? And the answer to this is pretty much always a yes.
I would argue that the situation is even better than what is stated by Graham. Let's say that you get a conventional mortgage loan for 3% right now, which is very much possible. If you take 0.7% off after you factor in the tax write-offs and then another 2% off for the average inflation rate, you are pretty much at 0% or close to it. That, my friends, is what you call a free mortgage. The question is now, can you make a better return doing literally anything else with your money? Folks, the answer is wholeheartedly yes. M1 Finance, my favorite brokerage company, is paying customers 1% just to keep their money with them. Or you can use their service and hire a monkey to pick random stocks in the stock market and get a better return than paying down your mortgage early. Spoiler alert, Graham actually even tried this himself and is beating the S&P 500 index right now. Link in the description below for the $50 free referral sign up and the video. Graham is absolutely right. You can make more money outside your mortgage than getting a 0% return by paying it off early.
The stock market has historically averaged about a 7.5% return adjusted for inflation. This means that if you prioritize investing over paying down your mortgage early, mathematically over the term of the loan, you should come out ahead. So with the points I just mentioned, let's take two scenarios here. In the first scenario, we have a 30-year loan for $400,000 at a 4.2% interest rate, which means your payments are $1,956, but you bump that up to $3,000 a month so you can pay it off in half the time in 15 years. Then after 15 years, once the home is paid off, you will continue investing the same amount you were spending on the property, $3,000 per month, but instead investing it in the stock market for another 15 years at a 7.5% return. When the 30-year time span is up, this means that you now have a fully paid off property. You've invested 15 years in the stock market, and that will bring you to an average return of $1 million. So after 30 years, you have $1 million in the stock market and a completely paid off property. But what happens if you don't pay down the mortgage early? What if you just keep the 30-year mortgage and instead of paying $3,000 per month, you just invest the difference? You put that extra $1,050 per month that you would be spending paying down the mortgage and instead just from the very beginning investing it in the stock market. But here's where things get really interesting. Now, because you didn't pay down the mortgage early and you instead just invested the extra money that you would have spent in the mortgage in an S&P 500 index fund that's given about a 7.5% return. Over 30 years, you'll have a paid off home, and you'll also have $1,433,000 invested in the stock market. This is $433,000 higher than the person who paid down their mortgage after 15 years and then just invested after that. That's an extra $433,000 over 30 years just by not paying down your mortgage early and investing the difference.
Now, Graham stops here with his arguments, but I will continue with two more reasons not to pay off your mortgage early that he did not even talk about. My biggest issue with paying off your mortgage early is that ultimately there is not an immediate benefit. Let me explain. With some other type of loans, when you pay more than what is required on the due date, it pushes the next due date back in proportion to how much of the loan you paid off. It saves you on the front end or the back end of the loan, and the choice is up to you on how you want to take advantage of that. However, with a mortgage, you can pay double or even triple what is required, and then 30 days later, you are required to pay your set mortgage amount on the first of the month on time. All it does is it goes straight to your equity, which is locked up unless you borrow against your property or refinance. The length of the mortgage only gets shorter on the tail end. Locking up my money faster would give me less flexibility if an emergency comes up in the future. I'd rather put that money in my M1 Finance brokerage account where it is more liquid and flexible. The second argument that Graham missed is that you fail to take advantage of the most beautiful thing about real estate that separates it from other assets: safe leverage. Let's say you bought a house for $100,000. You put $9,000 down and pay another $1,000 into the equity over the first year of the mortgage, which is a total of $10,000 that you have in the property. Now let's say the house goes up by 10% to $110,000 for appreciation after a year. What is the ROI for your purchase? You just doubled your money and got 100% return. Now on the flip side, if you put $9,000 down and then decided to pay an additional $11,000 into equity over the first year of the mortgage in order to pay it off sooner, you will have a total of $20,000 invested in the property. If the house now appreciates by 10% to the same $110,000, the ROI of that same house is no longer 100%. It is 50% for your first year. Your return is lower by paying off your mortgage early when it comes to appreciation. The reason they call real estate safe leverage is because the bank cannot call your loan due as long as you're keeping up with your payments, even if your house falls in value. If you borrow money against your stock portfolio, on the other hand, you can get what is referred to as margin called. The brokerage company will call you and tell you to deposit more money, or they will sell your stocks and take back their loan if the stocks fall below a certain price. This ruins many investors when there is correction in the market. This is why real estate is a wonderful tool if you know how it works.
Now, don't get me wrong here, because there are a few advantages of paying down your loan early. Even though mathematically in almost every single situation it's worth it to invest versus paying it down early, there are a few advantages, and this is what they are. The first advantage that I see is that if you have a really high interest rate of maybe above a 6% or so, it's probably best just to pay off the loan sooner than investing the difference. This is because the upsides of investing just get smaller and smaller the higher your interest rate is. At a certain level, the advantages of investing instead just become too small of a difference, and instead I would opt just to pay down the mortgage early, effectively just giving you a guaranteed rate of return. Now for me personally, if I had a loan above 6%, I'd probably just rather pay down the loan than invest. But if the loan is under 6% or so, long term, I would rather just invest my money instead. But the biggest advantage here of paying down the loan early is that with our above examples, we assume the person is actually going to invest the difference of the money that they would be paying down in their mortgage. Now, unfortunately, probably in most situations, the person is not going to be disciplined enough to actually invest the difference. Instead, most people will probably just pocket the difference and then recklessly spend it on things they don't really need or not really invest the full amount, and this just totally negates the whole advantage of not paying down your mortgage early and investing the difference. In order for this to actually work, the person needs to be dedicated enough to invest that extra money and not spend it. And I hate to say it, but probably for the average person out there, they're not going to have the discipline to do this, and it's probably a better idea they pay down their mortgage earlier, Even though mathematically they're going to be making less money, it's essentially just a guaranteed rate of return that's a lot safer than trusting them not to spend the difference. And this is far simpler for the majority of people to do. The next advantage here of paying off the mortgage early is just peace of mind. Now, even though you'll make less money, just having the mental clarity of not having a payment is extremely freeing. This in and of itself could mean you have less stress, you're less worried, and even though you're not optimizing every single dollar, the mental clarity it gives you could be worth it. Now, the next advantage of paying off the loan early is freeing up your cash flow. Now, even though this is a bit of a fallacy in that it actually lowers your cash flow by having your money tied up in a property instead of investing it elsewhere, it will make an immediate difference in the amount of money that goes into your pocket in terms of not having a mortgage payment and instead having all the extra money come directly into your pocket.
These are all good reasons to pay off your mortgage early. My non-financial advice would be to invest for right now and pay off your mortgage only when you want to retire tomorrow and you no longer want to deal with real estate. But that is everyone. Please check out the links below, and until next time.
As a thank you, don't forget to head to the description below to get your free stock from signing up for Robinhood. Then go over and get 4 free stocks when you sign up for a Webull account and deposit at least $100, with each stock being at least $8. You can also get $30 for opening up a free M1 Finance account. And if you're looking for a new credit card, I have a link in the description for a bonus of $200 when you spend $500 in the first 3 months.